Good morning, evening and afternoon traders. Welcome to this video. We've just had some data out from the UK, inflation data, sticking around the same, and we'll look for rhetoric from the Bank of England. Now, in this video, we're going to specifically look at gold, but that's just a little brief on what's happened. We've got Eurozone GDP and Japanese Bank of Japan later on today. So don't forget as well, you can join my private trading room underneath and get my free training too. So gold, what to do with it? Well, there's lots of people trading it. And if you've been following me for the last, since December at least, I've called it short and short and short and short, and it's fell routinely. So if you've been shorting on every pop-up in line with the natural market trajectory, which we've observed, well done. Okay, you can close out for various levels of gains. 2060 was quite an ideal area, or 2056/57. You had that a couple of times, and originally you shorted up here. Now it all comes off the back of a waning demand for gold. You can see that from this price rejection here, really long thin candle wick. So anything along here really is where orders were liquidated, and the need for people to hold gold, investors and traders, is just slowly diminishing. Okay, the reason for people buying gold has changed a lot. Traditionally they would get long, mainly as a safe haven asset. The position of gold in that regard has changed, immensely. So you don't always get that occur at those exact times when sentiment changes that way. But nonetheless, you've trickled and trickled and trickled for a couple of months now. Unsurprisingly, I did think the demand for gold would wane. I thought it was overdone as well. It was just too high. I mean, you have to understand that you'd already come up from October. Okay, it'd already been 2 months of up move. Some kind of retracement was always going to occur. Now, what you're getting into is previously hit support. Okay, for that reason, there's a little bit of level decay with it for me personally. It's a bit too soon since it was last hit. But nonetheless, across the board, you can see various levels of key rejection, key price action, and all these kind of candle wicks like that. Okay, so that may form the basis for support. Remember, your job as a trader is to be a detective. You're looking at price. What is it telling you? What does it do? And how can I make a future decision from that? Okay, and you can see 3 key points where you've been hit. Now, the only issue with it, like I said, is the time decay, but also the fact that it still looks very, very weak and it's trickling down. And you're at about $1988. So I think there's a bit of room to go. And I don't think you're going to stop immediately. I mean, you already had minor rejection there, didn't do an awful lot. So I think you'll trickle slightly lower. Now, I have spoke at length for a long time about getting it around 1975, 1976. I still think that may be ideal. Okay, you could stretch around 1974. Probably just depends a little bit on how your broker price is positioned. Now, that is a scaling in level. If you're a bit more risk averse, you could wait till about 1963. You may find you get underneath this monthly candle, okay, for December 2023. Now, that is really your first point of contention if you're going to be entering longs. And the reason why I've said about this so much, and I said, look, I'm not buying until you get there, is because you can see, and like I said a minute ago, you can see price has just been waning and waning and waning down. There is not a demand for gold, otherwise it would be going to the upside. The dollar is gaining strength, okay, which is pulling gold down. That comes after your inflation data coming in hot yesterday. So you can see slowly coming down and down and down. You have got reasonable support. Okay, you did previously come off 1975, so you could have a light long. Like I said, there's a little bit of level decay for me. It hasn't been an awfully, an extremely long time since you've hit it. It's been a fair amount of time. But really, if you're a risk-averse trader and you're looking to scale in, you could just hold off, maybe just dip your toe in lightly at about 1962 or something like that, because you've got areas of key price action at those points, like that, and there. So you may find you get a twist or a change in sentiment as well at the time, which allows you to trade with that newfound long bias. Now, having said that, if you do come even lower, there's another ideal level to scale in. You've just got to appreciate that the market is still very high on gold, okay? And it hasn't really fallen yet. If you look at the, these two last red candles, okay, it's reasonable. You went to about 21.50, you're about just under 2,000. So $170 or something, or $180 fall, not enormous, okay? You just have to be careful of it. So by the time you'll be scaling in another $20, that would take you from 2150 to 2160. Okay, like I said, $180, $190 by that point. And then failing that, like I said, I would just hold off. I wouldn't go crazy, and I would really rely on the key price action level along here. Again, price is still reasonably high if you're a swing trader off from these lows here. Okay, so that might constitute a medium size. There's no need to rush in with gold and go absolutely crazy and buy it. I would just scale in. You've got risk averse zones light up here, and then further risk averse zones light to medium. It's always important to be simply adjusting your risk as the market falls at any time, because if you aren't, your risk is not going to be tied to the probability. I mean, this level here is more probable than that one, because this level is higher up. And by probable, I mean chances of taking profit on any move. So your risk naturally would change at this point, okay, where you're coming to now, compared to anything down here much lower, in line with where you rose previously here, because that's your area of key price action. So you're coming to key moving averages, and again, really ideal 1963 area. Okay, anything from 1975, 1963 is going to constitute a long for me. Anything higher up, and it would probably require a reasonable push, at least 2030, or maybe higher, 2060 if you're more risk averse, for new shorts. So that's my full rundown on gold. I hope it helps. Remember, we're live every day to our Academy members. We teach a whole bunch of people around the world. You can get it underneath. Thanks for watching. See you in the next one.